Welcome back everyone. In this video, I would like to talk about the latest amendments to goods and services tax law, amendments which would influence how we pay the GST tax and also how we file GST returns. So GST law over the years has evolved ever since it was first uh, established in 2017, implemented in 2017 really. So in this year 2026, what has been the overall evolution? One is digital first compliance. Now currently when it comes to filing GST returns, there is a real-time validation of whatever data we input when we file the GST returns, and that real-time data validation, usually it's done by software present within the system. That is now a standard for all businesses which have a turnover exceeding rupees 5 crore, which means that when it comes to filing taxes, we are required to prepare this businesses, to be precise, they are required to prepare their ledgers digitally. So ledger management, the digital ledger management really has become more critical than ever when it comes to GST return filing. Then efficiency gains. Now apparently what has happened earlier, before these amendments, there used to be these tax rates for GST: 5%, 12%, 18%, 28%. Now the 12% tax rate has been removed. So what has happened because of the removal of this 12% tax rate is that there is a new strategic essentials first tax philosophy that has been imposed. Not just the removal of the 12% tax slab, even life insurance premiums are now exempt from payment of GST. So this is essentially one part of a strategy where the government is focusing on making sure that essentials are either exempt completely from GST or a low rate of GST is imposed on them. Then the amendments, they also focus on global ambitions. Essentially, there have been new export rules which have been implemented under the amendments, and there has been a certain thing called green track status which has been introduced. I will explain more about this later, but suffice to say for now, these new export rules introduced along with green track statuses, these are specifically designed to make Indian services highly competitive on the global stage. So moving on. So just to briefly sum up the amendments, so the rate landscape, the variety of tax rates which used to be imposed, they have been there has been some reshuffling in the tax rates. So what has been the reason for the changes in the tax rates? What does this change focus on? One is it focuses on social welfare. So any items which are deemed essential for living, let's say life insurance. Obviously, everybody needs life insurance because when we die, we want to be compensated by the insurance company. The family members of the deceased would want to be compensated for the loss. So life insurance, especially life insurance premiums, then life-saving drugs which would be necessary for medical treatment, and also education. In order to lower the cost of all these essential stuff and make them more affordable to the common public, the taxes or the GST which used to be imposed on these items have now been eliminated. Then another goal is mass affordability. When it comes to packaged food, electric vehicles, obviously there is concern about fossil fuel burning being hazardous to environment, so they are focusing more on electrical vehicles. Then daily essentials and MSME goods. MSME as in medium, small and large enterprises. All of these goods, there is a more focus on this either completely eradicating GST on these goods or lowering tax on these goods like 5% or so on. This is usually to ensure the green energy push. That is, this is a part of the government's approach to ensure a cleaner environment. Then catch-all services. When it comes to consumer electronics, restaurant dining, and small cars as in cars which should be bought by middle class people as part of their daily life, but not very luxurious ones. Then consumer electronics, since electronics are being used by pretty much everybody, so they are deemed as somewhat essential. Then restaurant dining, not really an essential, but one to which people are progressing more. So a standard rate is being applied to all of this. Then when it comes to high value consumption, now these are very luxurious goods which are absolutely not necessary. One is premium cars like BMWs and so on. Then tobacco, since smoking is considered harmful to health, so to penalize the bad habit, tobacco is a high rate of taxes imposed on tobacco. Then aerated drinks, cold drinks like Pepsi, Sprite and all we know of, they are all taxed at very high rates to ensure higher tax revenue and also to penalize people for bad habits in a way when it comes to tobacco. Then ITC set of rules, new ITC set of rules have been imposed now. So this usually applies to exports. So when you are filing a return on GST and you want refund on whatever goods you have exported, the documents by which you would seek refund is nothing more than a shipping bill which you filed with customs. Since under GST exports are largely regarded as zero rated exports, and these exports, they are eligible for refund on whatever input taxes you paid on services you used or goods you used for providing the services. So essentially under the amendments, there are new ITC set of rules wherein the ITC you availed is essentially used as for availing refund. So what are the new rules? One is there is a new rule which states that you can claim 90% provisional refund upfront. Whatever ITC you paid, you can claim 90% upfront. Then within filing a claim for refund, within 7 days, you can avail of the refund. It is required that you be refunded within 7 days. So what has been the change because of these two rules? One is when it comes to manufacturers, especially mid-sized manufacturers, there has been a 12% liquidity improvement, as in since they are getting more cash when it comes to refunds, so they have more liquid cash, especially including bank accounts, so they can use more funds to expand their businesses and such. Then another improvement is 15% capital improvement, as in there has been a reduction in how much amount of capital remains stuck. Okay, let me amend that. There has been a 15% increase in capital, because of which what happens is, because you get refunds quicker and faster and you have more liquid cash with you, so you don't need to take as many loans from banks and so on. So more funds available means more cash, less need of loans. Then under the new rules, there is a 30-day e-invoicing rules and mandatory bank validation. So what does this mean is, this especially applies to GSTR 1 and 3B filings. So one rule is, there is a bank account check. So when you are registering with GST, or when you are generating e-way bills, the GST profile that is showed while generating e-way bill, it must show verified bank details, as in what bank you have a verified bank account, or the GST profile must show that, otherwise your e-way bill generation would be suspended. Then next rule is 30-day reporting. This especially comes when you are filing GSTR 3B. So businesses who have annual turnover above rupees 10 crore, within 30 days they must file their own GSTR 1 returns and they have to report their invoices. Other, if they want to retain ITC, if the other person filing ITF, they wish to claim ITC, the other businesses who are filing GSTR1, they have to report the invoices. They have to file their return within 30 days. Within 30 days they must report the invoices. Then fresh document series. Another one rule is every 1st April you have to start a new invoice and credit note document series, as in you have to start a new series of invoices and credit note issues, and this has to be done at the beginning of every year. That way this ensures that there is a clean break from the previous year. Then GSTR 2B alignment, you are required to reconcile your GSTR 2B with whatever purchases you have made, entries you have made in your books, as in you have to make sure that whatever purchases the other suppliers have entered in their GSTR1, they are all tallying with the GSTR2B, that they have all been filed. That's the only way you could claim the ITC from GSTR2B. Then there is this thing called legal optimization pyramid. There is a 3 tiers of tax efficiency. One is procedural hygiene. One way is, now, so what happens is there is usually a huge problem where when companies are filing their GST returns, sometimes the other suppliers from whom they are making purchase, they don't file their GST returns on time, GSTR1, so which means the purchase invoices are often not available for claiming ITC. So to ensure that there is no tax leakage, or that companies are not crippled from obtaining more ITC, or that other companies who are filing their GSTR1, they don't exactly hide their tax amounts. So one way is to ensure 100% ITC matching, that is to ensure that less tax is not unnecessarily paid. So GSTR 2B and purchase invoices entered in your books, they are matching 100%, and all companies must abide with the 30-day e-invoicing deadline, as in the invoices must be filed in the GST website within 30 days. That way there would be a robust foundation for compliance. Then transactional structuring. Now under section 34 there is this thing called commercial discount, as in what happens is when you have made sales or purchases, but for some reason you want to provide a discount to the other party, you are required to issue a credit note in that case, and against that credit note, whatever ITC you availed of earlier, that has to be written off. Okay, not credit note, as in what purchases you made, sorry, what sales you made, again credit note, you have to provide a credit note for that, as I said earlier. So whatever ITC you availed of against purchases, yeah, that ITC has to be deducted with the proportionate amount of credit note, and so you have to avail of that, you have to follow that rule. Then when it comes to CGST SGST set off, you have to utilize flexible CGST SGST set off mechanisms, like when for instance you have conducted sales and there is IGST, CGST and SGST payable. Now under GST rules, CGST set off against CGST, SGST against SGST, but if you have surplus IGST, the best way to do is utilize the surplus IGST to set off CGST and SGST first, then utilize the CGST, SGST. That's how it works. Then another is structural arbitrage. Now under the new amendments, there are certain services which were provided, which were earlier considered as intermediaries, and even though exports are normally zero rated, the intermediary services weren't zero rated. But under the amendments, there are intermediaries which are also termed as zero rated. So which means that even you, if you are providing intermediary services and you have availed of input services, whatever tax you paid on input services, also you can avail ITC refunds on whatever ITC you paid. So you can capitalize on a zero rated intermediary status for that. So the tax compliance when it comes to 2026. Nowadays, GST audits are no longer conducted purely manually. There is some AI which has been implanted in the GST website, which is now used for the GST tax audit. So these AI driven audits, they delineate the boundary between safe tax planning and tax evasion. As in, what happens is these AIs, they make the distinction between safe tax planning and tax evasion which is done by illegal means. Okay, now delineate as in even though AIs are now used for tax audit, there is a risk of using these AIs. They do not make a proper distinction between what is safe tax planning and what is illegal tax evasion. So again, risk management strategies as of 2026 and green track status, all of these are impacted. So some examples are, let's say in your GST returns, you used post-sale credit notes. For instance, say some sales you had were returned, or you issued a discount or something. So under manual tax audit, it could be considered as post-sale credit notes because the human agents in charge of audit would understand that. However, AIs would not necessarily make that proper distinction. The software would mistakenly decide it as fictitious returns. So again, that posed a problem because the returns were not necessarily fictitious. It could basically, it was just discounts you issued, but the AI would think that is fictitious returns because it's been programmed to do so. So that's a problem. Then ITC claims. Legally speaking, manually GSTR to be matching is a thing where you match GSTR to be whatever purchases you have made, and on the basis of that you perfectly match the GSTR to be and use the ITC. However, the AI would mistake this for circular trading, as in the AI would think that purchases are being made repeatedly, which is not the case. You are just making the matches, but the AI would not understand that. Then when it comes to export services, the under manual audit, there is a thing called zero rating services. Some services, intermediary services especially, they are classified as zero rated, which means that these are exports but there is no tax on them. However, the AI would mistake this as misdeclared exports. The AI is programmed in such a way that it would classify all sales as liable to GST regardless of whether those sales were made within the country or outside the country. So the AI would mistake this as misdeclared exports when it is really zero rated services. Then again, when it comes to set-offs, manually speaking, there is a flexibility in set-off of CGST, SGST. First you set off surplus IGST, then you set off CGST, SGST. However, the AI would construe this as intentional mismatch, as in you are intentionally setting off the wrong tax, which is not the case. There are rules under GST for how you set off tax, but the AI wouldn't understand that. So again, that's the problem with AI in GST. The issue has to be fixed. It is being fixed slowly, but it remains to be seen how much it could be fixed. Then when it comes to intermediaries in exports, the exports for them are tax free. So recent amendments have transformed Indian intermediary service providers. Now how so? So how it used to be earlier, let's see that. So there is this group of companies called Indian SaaS firms. Now these are a class of firms which provide online services from a location in India to customers within India and abroad. Usually these are firms which run specific apps. So this type of companies, this type of online service providers, usually those who run apps and all, earlier they used to face an 18% GST liability on these intermediary services. This was largely because GST is decided on the basis of where the place of supply is, as in it there are different rules for GST, how GST is taxed, but one of the rules was where the place of supply of service is located. So because there was a lot of vagueness in place of supply when it comes to this type of company, so it was 18%. So because of which their services were more expensive than foreign services, so they were not so competitive. So the policy changes that have been made so far, the POS rules, place of service rules, has now been omitted for this type of companies. So the government has officially classified this type of services as exports now, which means they are also now zero rated. So for these firms also, they can now use zero rated invoices. They can claim refunds on ITC just like other export related companies. So what has happened because of this is, because they have been moved to 0% GST and because they can claim refund on ITCs, so there has been a 11% boost in the margins of these firms. So that's quite an improvement. So this is one of the amendments which the government has done to make our exports more competitive globally. So how to conduct your audit or how to file your returns under the new amendments? One is to review your HSN codes. Now this is important for reviewing HSN codes because earlier what it used to be, the tax rates were 0%, 5%, 12%, 18% and 28%. Now 12% is gone, so is 28% apparently. But instead there are four tax rates. One is 0%, one is 5%. Now there is 18% is retained, but instead of 12% and 28%, there is a straight 40% GST slab now, which means that for luxury goods, premium goods, they are charged even higher now, 40%. So when you file your GST returns or and so on, you must audit your HSN codes. Make sure your HSN codes are for the proper goods, that in order to align with these units, that way you don't accidentally get struck with a higher rate and so on. Then another way is e-invoicing workflow. It is best to standardize your e-invoicing workflow, as in it's best to ensure that whatever e-invoices you file it within the 30-day time limit specified under the amendments. So essentially standardize your e-invoicing workflow. That way all mandatory documentation is done and reported, processed within the 30 days. Then another way to take advantage of this amendments is to maximize your exports. Now that intermediary services are also classified as zero rated services, especially online intermediary services. So one way could be to expand your business. If you have an export business, you can expand it to include intermediary services also. And the green track status, which I talked about earlier, where you can avail 90% provisional refund on applying for it within 7 days only. So you could leverage that for faster processing of refunds, so that you don't have to avail of loans, so that more cash is available to you for business purposes. Then real-time tracking, you could implement real-time reconciliation of GSTR 2B and invoices to ensure that your ITC in the context of physical purchase invoices entered in your books and invoices entered in GSTR to be they match. So you could use the correct ITC amount on time in order to avail the benefit of reduced tax. So now when it comes to GST, there are new amendments coming every year, probably every couple of months. So when it comes to 2026, whatever amendments that I have stated in this video, it is advisable to implement all of those amendments, to take advantage of those amendments before the next year comes, so you can avail of the benefits quickly before the government makes an adverse change to these amendments. They do many times. So once again, thank you all for watching this video. I hope this video helps you all in your GST tax payment and return filing. And those of you who are in the export business, I hope this video also helps you all to take advantage of the new amendments for to have more earnings and so on. So I hope this video has proven enlightening to you all. Please watch, please like, comment, and recommend this video to anyone else. Please subscribe to my new channel. Please subscribe to my channel at Siddharth Bhatt 4898 and recommend my channel to anyone else. Once again, thank you all for watching this video. Thank you all for your time. Thank you all for watching the video. Thank you all. Thank you.